Hello friends, today we are going to discuss about deferred tax, Ind AS 12. Let's understand what is the need of deferred tax before we understand how to calculate and how to report it. Let's take an example. There is a company XYZ Limited and it does the business of trading of motorbike, and during 22-24 the company purchased 100 motorbikes at the rate of 50,000 each, and during 23-24 the company has sold 60 motorbikes at the rate of 60,000 each. So you can see there is a profit of around 10,000 per motorbike. So the profit earned or reported under accounting rules is 6 lakhs, 36 lakhs minus cost of 30 lakhs. Now take the same scenario under Income Tax Act. Suppose the Income Tax Act states that 10% of the purchase cost will not be allowed as deduction from taxable income 23-24, and it will be allowed during 24-25. Then in this scenario, the cost allowed is 45,000 each, that is 90%, because 10% will be allowed only in subsequent year. So what is the profit as per the Income Tax Act? 36 lakhs less cost of 27 lakhs. So profit is 9 lakhs. So in the above example, the actual profit earned by XYZ is 6 lakhs as per the accounting books, and the company is supposed to pay 30% on that, assuming 30% is the tax rate. So the tax liability should be 1,80,000. But what happened? Because under Income Tax Act, 10% of the cost is not allowed during the year. Hence the profit has gone up to 9 lakhs, and the company is going to pay a higher tax at the rate of 30% is 2,70,000. The accounting matching concept states that revenue and its relevant cost has to be accounted in the same accounting year. In the given example, the actual tax liability is rupees 1,80,000 and the company is paying higher tax of rupees 90,000 because 10% of the cost is claimable in subsequent year and not allowed during 22-23. So profit after tax under matching concept, if you see here, sales is 36 lakhs, cost is 30 lakhs, profit earned is 6 lakhs, and the company should pay income tax at the rate of 30%, that is 1,80,000, and profit after tax should be 4,20,000. But what is happening under Income Tax Act? Under the Income Tax Act, the cost allowed is only 90%. Hence, the tax liability has gone up. And the tax liability what the company is going to pay is 2,70,000 rupees. Because of the income tax rules requirement, the tax liability has gone up and the profit after tax is 3,30,000 rupees. And what is the accounting entry the company is going to post? Current tax account 2,70,000 rupees to provision for income tax 2,70,000 rupees. Current tax is the amount of income tax payable or recoverable for the period as per the tax laws. In the previous slide, that because of higher income tax, the profit after tax is reduced, and in the current scenario, instead of 1,80,000 rupees, the tax liability is 2,70,000 rupees. Hence, the profit after tax has reduced from 4,20,000 to 3,30,000 rupees. However, the excess tax paid of rupees 90,000 will be adjusted with next year tax liability, as 10% cost not deducted during 23-24 will be allowed during 24-25. This excess tax paid is an asset which will be utilized during 24-25. This is called as deferred tax asset. So how the scenario will change now? If you see, sales is 36 lakhs, cost is 30 lakhs, profit is 6 lakhs, income tax liability as per the income tax rules is 2,70,000. Company will be passing an entry for deferred tax asset. So deferred tax credit is 90,000 rupees. The meaning of this is that this 90,000 rupees you are going to take credit in future. Okay. And the profit after tax is tallying to 4,20,000 rupees, which was expected while calculating under accounting rules. So the entry what the company is going to post now is deferred tax asset of rupees 90,000 to tax credit of rupees 90,000. Before we understand Ind AS 12, Let's understand under AS 22 how the deferred tax was calculated. So the approach used under AS 22 was profit and loss account approach, whereas under Ind AS 12 the approach is balance sheet approach. So we'll talk a lot about balance sheet approach in upcoming slides, but you can understand that the approach used in both AS 22 and Ind AS 12 is different. Okay, so we'll try to understand through an example. Let's take we have one asset. The cost of the asset is 1 lakh, and this cost is reported 1 lakh in both tax record as well as income accounting records. The depreciation per year is 10,000 under accounting rules, and it's 20,000 under tax record because the tax rates are higher. The written down value under accounting record is 90,000 rupees, whereas under tax record it is 80,000 rupees because of higher depreciation. This 90,000 rupees, what is reported under accounting records, is called as carrying amount of the asset, and 80,000 what is reported under tax record or income tax laws is called as tax base. Okay. So now let's try to understand under AS 22 how the deferred tax was calculated. Okay. The difference in depreciation, that is 10,000 rupees between accounting records and tax record, is 10,000 rupees. This difference will be reversed over the remaining life of assets, because what will happen, because the accounting record applies lower rate of depreciation, the life of the assets will be for a longer period. Okay, hence we call it timing difference, and in future years accounting depreciation will be greater than tax depreciation, because after 5 years there will be no value under tax records because the rate of depreciation is higher. As the depreciation expense is more in tax records, the entity pays less tax in the current year. Correct? When we say less tax, it actually liable to pay more considering accounting records. It means the current year profit is not correctly taxed. Hence, the entity should create a deferred tax liability DTL for rupees 10,000 into 30%, assuming the tax rate is 30%, amounting to rupees 3,000. And debit tax expense and credit deferred tax liability. So this is similar to what we explained in the previous slide. You create the additional liability here because in future the depreciation under tax income tax will be lower than accounting records, hence you have to pay more tax. So you are creating a liability. So now let's understand the previous example more in detailed way to understand how the deferred tax liability is created and how the deferred tax liability is reversed in future years. So in the given case, we saw that the depreciation under Income Tax Act is higher and the depreciation under the accounting rule is lower. And as the depreciation is 10,000 rupees per year, the life of the asset is 10 years as per the accounting rules. And at the same time, what is happening under Income Tax Act, because the depreciation rate is 20,000 rupees per year, the asset is completely written off within 5 years. And after 5 years, there is no depreciation claim under Income Tax Act. So what is happening in the first 5 years? In the first 5 years, the company is claiming higher depreciation under the Income Tax Act, and the tax benefit generated at the rate of 30% is 3,000 rupees per year. That means the company is paying lower tax of rupees 3,000 rupees per year. So the tax benefit lost because of no depreciation under Income Tax Act, that starts from 6th year, the company is not able to claim 3,000 rupees per year because there is no depreciation claim under Income Tax Act. However, there is a claim under accounting rules, but as this is not allowed now because the asset doesn't exist under Income Tax Act, it's a loss for the company, right? So as per the matching concept, we need to create deferred tax liability every year to the extent of 3,000 rupees. The saving what you have today will be paid as a liability in future, correct? So we create a liability in the same year. And what is happening? The net impact in accounting records, that the tax benefit minus the tax liability what you are creating is n to 0. This is where the matching concept works. So if you see here, the net impact under the accounting records for all the year is nil because we are creating deferred tax liability. Okay, so the saving what you are having it here, we are reducing the saving by posting the entry of deferred tax liability. And when we don't get the benefit from the Income Tax Act, we start utilizing the liability. That means we will be showing expenses paid during these 5 years. Okay, and the accounting impact is nil for every year. Try to understand how Ind AS 12 is different compared to AS 22. So in the beginning we understood that AS 22 follows profit and loss account method, whereas Ind AS 12 follows balance sheet approach. So the effect remains same in the balance sheet approach, but the way of thinking and calculation changes a little. Carrying amount of the asset is 90,000 rupees and the tax base is 80,000. Difference is 10,000 rupees. The carrying amount of asset is rupees 90,000 means the entity gets probable future economic benefit of rupees 90,000 by way of use or sell, and which will be taxed in future. This is comparatively more than the tax base, that is rupees 80,000. It means the entity is liable to pay more tax on rupees 10,000 rupees, that is 90,000 minus 80,000 rupees. So tax on the difference amount is postponed or deferred. Hence, it should create a deferred tax liability of rupees 10,000 into 30%, assuming 30% is the tax rate, and debit deferred tax expense and credit deferred tax liability. So under balance sheet approach, the point here is that it compares the amount, carrying amount with the tax base and checks whether you are going to earn more economic benefit in future. If you are going to earn more economic benefit in future, you will be paying more tax. Hence, the deferred tax liability is created. So the working is different, but the logic is same under AS 22 and Ind AS 12. Difference. What is the meaning of temporary difference? This is the difference between the carrying amount of asset and liability as per the balance sheet, that is as per your accounting records, less tax base, that is the book value of asset and liability as per the tax laws. And the difference between the carrying amount and the tax base is called a temporary difference. Now question is, why this temporary difference is very important? Because on temporary difference, the entity recognizes deferred tax asset or deferred tax liability. And this temporary difference should be checked at every balance sheet date, and such difference is reversed, reduced in subsequent year, detail to be reversed accordingly. Okay. So in our previous example, we saw that the carrying amount was 90,000 rupees as per the accounting rules, and 80,000 rupees was the tax base because of higher depreciation. And the temporary difference was 90,000 minus 80,000, that is 10,000 rupees. And we saw that how this 10,000 rupees was considered in determining the deferred tax liability. In the previous slide, we understood that for calculating the temporary difference, we require carrying amount as per the books and tax base amount as per the income tax laws. Now the question is, how do we determine this tax base? Okay. So let's understand tax base of an asset. Tax base of an asset is based on the taxability of economic benefits from the asset. Okay. We'll try to understand what is the meaning of that. So economic benefits means revenue generated by using the machine, any gain or loss on disposal of the machine. Okay. So the tax base of an asset is the amount that will be deductible for tax purpose against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. If those benefits arising from the asset will not be taxable, the tax base of the asset is equal to its carrying amount. Okay. So let's understand in a flow. So if the economic benefits are taxable, that means the asset which we are carrying in the balance sheet as per the accounting records, if it generates economic benefits in future, whether that is taxable. If that is taxable, the amount deductible from taxable economic benefit flow to the entity is the amount is the tax base. And if the economic benefit are not taxable, then the carrying amount is equal to tax base. let's go through few examples to have more clarity how the tax base has to be calculated for an asset. When economic benefits are taxable, a machine cost rupees 1000. For tax purpose, depreciation of rupees 300 has already been deducted in the current and previous periods, and the remaining cost will be deductible in future periods, either as a depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. What is the tax base? So in the previous slide, we understood that if the economic benefit is taxable in future, then the amount will be deductible and will be treated as tax base. So in this case, the tax base is the amount deductible from future taxable economic benefits flow to the entity. In the given case, rupees 700, that is 1000 rupees minus depreciation of 300, is deductible in future. So whenever we have revenue in future, this asset of rupees 700 will be allowed as deduction in the form of depreciation. Hence, the tax base here is rupees 700. Now let's take another example. In the books of X Limited, an amount of rupees 25,000 is recorded as rent paid in advance, or you can say as prepaid expenses. For income tax purpose, the amount is deductible on accrual basis. That means when you incur the cost, that is in future years. Determine the tax base of the asset. So in this case also, income tax is going to allow you this expense as a deduction in future period. Correct? So total amount of advance rent will be deducted from the future taxable income. Hence the tax base is 25,000 rupees. Let's take another example. What is the tax base of inventory? Because inventory is an asset, current assets, and whether you are going to claim as a deduction in future is the question. Correct? So in case of sale, the total amount of inventory is charged as against the revenue as cost of goods sold. So this inventory will get converted to cost of goods sold and will be reported as part of profit and loss account, where this amount will be adjusted with revenue and is allowed under Income Tax Act as well. As the entire amount is deductible from revenue, the carrying amount is the base. Now let's see a few examples where the economic benefits are not taxable and how the tax base is calculated. Let's take an example. X Limited recorded dividends of rupees 25,000 receivable from its subsidiary. The dividend is exempt from tax. Determine the tax base of the asset. So dividend is not taxable, hence tax base of the asset equal to its carrying amount. Therefore, tax base of dividend receivable is 25,000 rupees. Let's take another example. XYZ Limited reports accounts receivable of rupees 10,000. Determine the tax base of the asset. So in this case, the economic benefits receivable from the said asset is already included in the taxable profit when sale occurred. Correct? And on receipt of the money from the debtor, it is not taxable. Hence, tax base equal to carrying amount. Therefore, tax base is rupees 10,000 rupees. So in this case, you have to keep in mind that the amount which is lying with the customer will be received in subsequent year, but will not be claimed as any deduction. Correct? And the economic benefit has already flown to the company, and in the current year it is taxable. ABC Limited reported rupees 15,000 as loan receivable. Determine the tax base of the asset. The repayment of loan will not have any tax consequences. Hence, tax base equal to carrying amount of rupees 15,000. Tax base of an liability. So in the previous slides, we understood how the tax base will be calculated for assets. Now let's try to understand that how the tax base will be calculated for the liabilities. So tax base for liability, there are two scenarios. One is liability for revenue received in advance. That means your customers have paid you in advance, and other liabilities. So in case of liability for revenue received in advance, the formula what we need to calculate is carrying amount, that is as per the accounting records, less revenue that is not taxable in future. This is very critical to understand, that we have to keep in mind that revenue that is not taxable in future. Many people do a mistake that they understand revenue is taxable in future. Actually, it is not taxable in future. The tax base of liability is difference between the carrying amount and revenue that is not taxable in future. Coming to the other liabilities, it is carrying amount less any amount deductible for tax purpose in future periods is the tax base of the liability. Let's go through few examples to understand how the tax base of liability for income received in advance is calculated. Rent received in advance rupees 10,000 rupees already taxed on receipt basis. This amount will not be taxed again in future. Determine tax base of the liability. So here under Income Tax Act, the rent is taxed on receipt basis. Okay. And in future, when you account this as income under the accounting rules, it is not taxable. In that scenario, the tax base for advance income equal to carrying amount minus revenue that will not be taxable in future. Correct? Since already the amount is taxed on receipt basis, it will not be taxed in future again. Therefore, tax base equal to rupees 10,000 minus rupees 10,000, because 10,000 is not taxable in future. Hence, the tax base is nil. Now, let's take another example. Determine the tax base of the liability in the above example considering rental income taxable on accrual basis. So we are changing the scenario. The example, first example is more about on the receipt basis, and example 2 is on accrual basis. So what's happening here? It means the rent is taxable in the year of accrual, that is in future. The non-taxable revenue in future is nil, as full rent amount will be taxable in future years. So tax base is rupees 10,000 minus 0 equal to 10,000 rupees. Let's take another example. Advance received for supply of goods and services is rupees 2 lakh. This is shown as liability in books of the entity. What is the tax base of this liability? This advance received for supply of goods is taxed on accrual basis when revenue is recognized. As the question is silent whether it is on receipt basis or it is on accrual basis, it is assumed that it is on accrual basis. Tax base equal to carrying amount minus amount of revenue that will not be taxable in future. So here tax base is rupees 2 lakh minus 0 equal to rupees 2 lakh. Why it is 0? Because the complete amount is taxable in future and our formula talks about not taxable, hence it is 0. Now let's take few examples on tax base of other liabilities, that is other than advance for revenue. A Limited created a provision of rupees 2 lakhs towards bonus. Such expenditure towards bonus is tax deductible only on payment of that liability when bonus is actually paid, being subject to section 43B of the Income Tax Act. Determine tax base of the liability. The tax base of other liability is carrying amount less amount that will be deductible in future. That is rupees 2 lakh minus 2 lakh equal to nil, because this 2 lakh rupees, whatever liability is reported under the accounting records, will be claimed as deduction from the income. Hence, the tax base is nil. Example 2. A company has made provision for warranty cost of rupees 1 lakh in its accounts. The tax laws do not permit deduction until the company actually incurs the cost. Determine the tax base. This is similar to example 1. So the tax base is nil, carrying amount minus amount that will be deductible in future. So 1 lakh is the carrying amount as per the accounting records, and 1 lakh will be claimable in future when it is actually paid. Example 3. Current liabilities includes accrued fines and penalties with carrying amount of rupees 10,000. What is the tax base of this liability? So here if you see about fines and penalties, these are not deductible for tax purpose. There is no temporary difference in this case. So the tax base equal to carrying amount minus amount deductible for tax purpose in future. So this 10,000 is not deductible. Hence tax base is 10,000 minus 0 equal to 10,000 rupees. Base of items not recognized as asset or liability. That means in the accounting records, these items are not reported as an asset nor a liability. So let's see what are the cases and how it has to be recorded for deferred tax purpose. Some items may not be recognized as an asset or liability in the balance sheet, but still may have a tax base. For example, preliminary expenses, as it is recognized as expense in the year in which it is incurred, but for tax purpose, it will be allowed in the future years. In such case, tax base equal to the total amount which is deductible for tax purpose in future. Let's take an example. A Limited is incorporated in the current year. It incurred preliminary expenses of rupees 5 lakh for incorporation. It has been charged to revenue in the first accounting period itself as per the accounting rules. The tax laws allow deduction of this item over a period of 5 years. What is the tax base? So preliminary expenses are charged off to profit and loss account. Hence the carrying amount is nil as per the accounting records. However, since 1/5 of the amount is debited for tax purpose in the current year, remaining 4/5 will be allowed in future years as per the tax laws. Therefore, tax base is the amount deductible in future, that is rupees 4 lakh. 5 lakh minus 1/5, that is 1 lakh. Now let's try to understand how the deferred tax is calculated. Temporary difference, what we understood in the previous slides, carrying amount, that is your accounting books, minus tax base as per the income tax. Deferred tax is recognized only on temporary difference, whether it is a DTA, that is deferred tax asset, or DTL, deferred tax liability, is based on the type of temporary difference. Okay, so there are two types of temporary difference. Taxable temporary difference, that means currently it is not taxable, it will be taxable in future, so it is a taxable temporary difference. Another one is deductible temporary difference, that means the expense is not allowed now but will be allowed as deductible in future years. Taxable temporary difference and deferred tax liability. A deferred tax liability shall be recognized for all taxable temporary difference, because you are deferring the taxable income to future. Obviously, you have to pay excess tax in future years. So it is a deferred tax liability. So what could be the scenarios? There are two scenarios. Carrying amount of asset is more than tax base of asset. This is the same example what we discussed in the first slide, where the carrying amount was 90,000 rupees and the tax base was 80,000 rupees. So more economic benefit of rupees 10,000 rupees will be flowing in future years. Hence, company has to create more deferred tax liability. And in the reverse case, the carrying amount of liability, if it is lower than tax base of liability, then that is a taxable temporary difference and you have to create a detail for it. Coming to the second scenario, deductible temporary difference and deferred tax asset. A deferred tax asset shall be recognized for all deductible temporary difference to the extent that it is probable that taxable profit will be available against which the deductible temporary difference can be utilized. So here you have to be careful before recognizing the DTA. The company should have good amount of projections about the future inflows or future economic benefits. If there is no certainty that the company will be earning good amount of profit, taxable profits in future, then the company can't recognize the DTA because it can't utilize the DTA in future. Situation here is, if the carrying amount of asset is lower than the tax base of asset, then DTA need to be created. Similarly, carrying amount of liability, if it is more than the tax liability or tax base of the liability, then DTA need to be created. Unused tax losses and unused tax credits. A deferred tax asset shall be recognized for the carry forward of unused tax losses, that is your taxable losses which you can carry forward for certain years. In India it is 8 years. And unused tax credits to the extent that it is probable that future taxable profit will be available against which the unused tax losses and unused tax credit can be utilized. Hence, future projections are need to be reviewed and to be checked before any DT is created in the books of accounts. Thank you.